Hello and welcome, everyone. Good day. Welcome to the second webinar in our new marathon on volume analysis, order flow, level 2. Welcome. Good to see every single one of you in the chat. Today, we are going to dive deep into the topic that is interesting for all kinds of traders. Every single trader, when coming to the market, actually faces sooner or later this situation we're going to talk about today. We're going to be diving deeper into the topic of market traps, market manipulations, liquidity grabs. So how large players hunt for the retail traders' liquidity, trigger false price movements, and most importantly, how to recognize those patterns and use them for our own advantage and benefit. Before we're going to get started, let's make a usual quick tag check. If you can hear me, if you can see the screen well, can you please put a plus in the chat so I know that everything is working? And it also gives another 10 to 15 seconds for all those who are late to join our today's webinar. I see some pluses in the chat. Sven is here. Welcome. Thank you so much for the feedback. Gorgeous. Ivan, добрий день. Vadim, Fan is here. Cryptotomic, dzień dobry. Welcome, Ali. Good to see you again. Usman is here as well with us. Muhammad, Dmitry, Rax, Sam, Tomo, Martin. Okay, fantastic. Good to see every single one of us, every single one of you here. Familiar names, familiar faces. Glad to have all of you on board. This is our second webinar of the series. We're going to have 5 webinars in this specific series, level 2, and then perhaps more depending on your feedback. So glad to see every single one of you. If you know that your friends, your colleagues yet are not watching our marathons, please do invite them after our today's webinar so they can also benefit from the knowledge that is shared here. So after completing the first marathon and watching the first webinar of the second series, you already have a very solid foundation. You're familiar with those things like cluster analysis, for example, the footprint, basis of volume indicators, and even the market types of structures and models that we discussed on our first webinar 2 days ago. And today we are going to be expanding into something very important. And here is the plan for our today's webinar. So we will be discussing traps, manipulations, market liquidity, and we will be starting by diving on what types of manipulations occur in the real market. So what stop runs are in general, what are the false breakouts and what do they look like? And why and how large players intentionally trigger them. We will be exploring why the price often behaves kind of dishonestly towards us as traders, so at least it feels like this to us when we get our stop loss hit and then price just goes straight to your take profit. Those are kind of not nice situations to be in, but every single one of us as traders did have this experience at some point. And then later on, after discussing the types of manipulation in the real market, we will be introducing the concept of one of my favorite tools. And this tool can act as so-called holy grail. And as much as I really do not like calling any of the instruments like this, the concept of accumulating delta is going to allow you to dive into the manipulations in the real market like never before. And you will be able to predict them before they actually happen, which will allow you to obviously have a massive advantage compared to the rest of the retail traders around the world, and also benefit from it and get some potential profits. We will be refreshing also what the normal delta is from the first series of our marathon. So for those of you who haven't watched it yet, do not worry. We're gonna remind ourselves and refresh some terminology. So this is really honestly one of the key order flow indicators for me personally. And this will be the basis of the material that follows next. Next, we will be examining how exactly cumulative delta behaves during the market traps and manipulations. So you will see how its signals can either warn of a false move that is coming or confirm that retail traders are caught in a trap. We will be going through typical trap scenarios, both for longs and for short type of positions. And we will be discussing specific trading methods in those situations using signals from cumulative delta and the rest of the ADAS tools. And all the way at the end, I'm going to show you a couple of live examples on the charts on a few instruments, like for example, euro futures, pound futures. We can also tap into gold or S&P 500, for example, if you wish so. So let's see in the end. And we will be identifying cases of those false breakouts and stop runs and analyze them using ADAS cumulative delta chart. Okay, so those will be the visual demonstration of how to apply everything that we've covered today. We are going to cover today. And after the main part and the practical part of our today's webinar, we'll leave around 10 to 15 minutes for the Q&A, where I will answer all of the questions on today's and the previous topics. Okay, so if you will have any questions, please make some notes. Remember that in the end, we have the special time specifically for the questions and answers. So don't worry, all your questions are going to be definitely answered. And you can also post them in the chat. Feel free to post them anytime during the webinar. And as much as if sometimes I might not answer them immediately, don't worry, I'm going to get back to them in the end of the series. So before we begin, please write in the chat, where are you from and how long have you been using ADAS platform so far? I'd really love to get to know you better and understand your own experience level as well. So please type in the chat the city, where you're from, or the country, whatever you wish, and also how long have you been using ADAS? And I'm going to start, okay? I'm from Ukraine. I'm based in Spain, and I've been trading using ADAS platform for the past 5.5 years. And since I started using ADAS platform and implementing volume profile analysis, order flow, I've got a breakthrough in my trading career like never before. I realized that a lot of traders ask a wrong question. They ask how instead of asking why. So they are asking, how do I find an entry point or exit point, instead of asking, why does the price move? Why does the price reverse? So instead of asking and understanding the core of the price movement, the core of the market auction, we as newbie retail traders often get led in the wrong direction. And we search all over the market, all over the internet for the strategies that only answer the question how to, but do not explain the reasoning behind. And those things, unfortunately, have short legs, because sooner or later the market changes and we are back at the square zero, where we need to figure out all of our strategy back again. So since I started to use ADAS 5.5 years ago, my trading career took a really, really different turn, which I wish also happens to you after the second series of our webinar. So let me go back to the chat and see, where are you beautiful people from? Slovenia, Mitya, staying 2 months. Good to have you here. Welcome. Usman saying Pakistan, 1 week. Great. I hope those series of the webinars are going to have build a strong foundation for you to how to use ADAS platform. And if you have any questions, please do let us know in the chat. We are here to help you. Okay, Mexico, about 8 months, Martin. Welcome. I love Mexico. Amazing country. Greece, another beautiful country, using ADAS for 2 years, Georgios. Welcome, great. Great. Poland, Tomek, dzień dobry, witam. Od 2 lat, now planning to go back to it 2 years ago. Okay, good. I hope those webinars can give you some motivation for why to come back to the ADAS platform. Impal, Netherlands, 4 years, Luda. Good. We have some very experienced people also in the chat. Chill ADAS for 2 months. Las Vegas, new to ADAS. Anthony, good to have you here. Welcome to ADAS family. Dublin, using ADAS for a month, learning quickly. Fantastic, Vadim. This is amazing. For learning quickly. This is great. Some people feel like it's difficult to shift, but I found out that it's difficult sometimes to shift what we are used to, but it's really necessary if we want to get different results, right? We cannot make the same exact action, do the same exact things, and expect different results in our trading. So, Vadim, good to have you here, and glad that you are joining the Aras family. Nigeria, haven't used Aras before, still confused about setting up the software. If you go back to the first webinar series, to the first marathon, in the first few webinars, I show step by step how to set up Aras platform. And in the end of our today's webinar, after the webinar is finished, in the link of the description, you will find a link to download that template, which you can import in your Aras platform, and you will automatically have the same settings as the one that I'm going to be using today. So you will have your chart set up and cumulative delta indicator already added to your chart automatically. So this should ease and make it lighter, quicker for you to set up the platform. So David, don't worry if you're not confident with it yet. Just download the platform and install it. It's going to take you about 5 minutes. And then in the end of the webinar, download the template from the description of the video, and you're going to have the same link by your email that you can access, and import this template. It's going to make your start with Aras much, much quicker. Puerto Rico, 1 year. India is here. Netherlands, 2 months. France, 2 years. First time. Ukraine, new to Aras several weeks ago, installed Aras. Dmitry, good to have you here. Дуже дякую за довіру, Dmitry. Austria, just starting. Michael, great. I remember you, Michael. Good to have you back. Користуюся декілька тижнів. Україна. Іван, добрий день. Дуже дякую вам за довіру. Сподіваюся, що ці вебінари стануть таким стартом до платформи ATAS. Starting Aras since 2024, Germany, great, fantastic. Thank you so much for all the answers. I'm glad to get to know you better. New York is here as well. Fantastic. Really, really good to have every single one of you here. So, and today we're going to be diving into all of those things. If you haven't used Aras yet, it's all right. If you have any questions how to install it, let me know in the chat. I'm going to be here to help. If you've been using it, hopefully today's webinar is going to be an even deeper dive into the order flow and the abilities of the Aras platform and some indicators. And excellent. Let's get started and let's move on to our first section of today's webinar. So what is manipulation in the real market, and which types of manipulation in the market do we have? Right? Last webinar 2 days ago, we were covering different types and states of the market. It was accumulation, manipulation, and distribution. We were combining it with balances and imbalances. So when the market is balanced and imbalanced, remember that accumulation is the only balanced market. The rest is imbalanced market. And we were combining it with their topic of volumes and volume profile. Now, which types of manipulations, right, the period of manipulation can we notice in the market? I selected the 4 main ones upon which we will be building afterwards our trading system and the trading methods discussed on today's webinar. The first one is false breakouts. It's a very classical drop, and I'm pretty sure that every single one of you has seen it at least once or perhaps many times. Throughout the past almost 9 years in trading, I've seen it countless times. When the price breaks a very important support or resistance level, draws traders' attention towards it, but lacks follows through, continuation of the movement, and quickly snaps back. Why does it happen? Well, because above resistance or below supports sits a wall of liquidity, stop losses from existing positions, and breakout entries of retail traders waiting to be filled. So when the market ranges, we actually covered it last time, a lot of retail traders try to either trade inside the range, and then they place their stop losses and take profits just above resistance or below support. And they also try to trade on the breakout. So they place buy stop orders and sell stop orders above and below the range accordingly. Because of this liquidity that is above and below the range, the big market players, big market participants, hedge funds, institutions, and high frequency traders, and so on, usually false break out those levels because they know these zones. They push the price to reach them and quickly fill in those orders, collecting that liquidity. And once those orders are filled, the big players execute the opposite side, meaning, for example, selling to breakout buyers or buying from the stopped out sellers, and price quickly returns back. On the chart, that's your false breakout. So the spike and then the reversal backwards. So you will also see it called as stop run, basically same effectiveness to the mass stop out sweep kinda in the market, okay? And so often these moves happen by the market makers or other big players where their profit equals someone else's loss. Last time I had the question, why would the big market players, if they are the liquidity of the market, need our money as they're, for example, the big player, right? Why do they need our money as retail traders? Well, because market works as an auction. And there are always two sides in the market. If I want to make money, I need to take it from someone else. This is how the market works. For you to be able to make money in market, you will have to take it from someone else's pocket. The same for the big market players. They need to take the money from somewhere to be able to make it. And it seems like our retail traders' money is not significant, but if you calculate all millions retail traders around the world and the amount of money they lose by those false breakouts and manipulations, is going to be a very significant amount. So the big players take the liquidity because they need to make money from somewhere, and the easiest way to make money in the market is to stop out retail traders. Second, stop runs, or you can also call them the stop loss hunting. You probably heard that before. Think basically of them as a specific kind of false breakout. So we can classify them as a false breakout, but a very specific type. Let's say, imagine that you trade 6E futures, so euro futures, and you have a very obvious level of 1.2, right? Many traders are going to put their stop losses just below the support of 1.2, and others are going to be setting that stop order, sell stop order, right under the support. So logic is exactly the same, but instead of consolidation, you basically have the support or the resistance. The price, this is why I never trade, and I want you to make some notes on this. I never trade from the same support or the same resistance unless it's using cumulative delta that I'm going to show you later. There are only two times when I trade from the same support or resistance level, otherwise never. Apologies. And why? It's because usually before the price goes somewhere and rejects the support or resistance, it creates a lower low or the higher high. Why? To be able to collect the stop losses and hunt the stop losses of the retail traders. So the market creates a false sharp movement, absorbs the stop losses and sell stops or buy stop orders, and then when stop hunts happen, the price returns back to the support or resistance. I will be drinking water during today's webinar because I'm a little bit sick, but I'm going to do my best to be able to stay on track with you, okay? So the third type of the manipulation in the real market is the short trend trap. And this one is something that retail traders are usually not familiar with. So let's cover this one as well because it's quite important and significant too. You can see it as a swift, short-lived trend that kind of convinces traders that a major move has started. So the retail traders usually think that a major trend starts, but after the short-term movement, the price usually reverses against the late entries of retail traders. Example can be the following. Price rallies strongly for 2 days, for example, and breaks local highs, and like you also can see the spikes on the volume indicator. Crowd, so retail traders, buys the idea and believes that bigger bull trend has begun. Once most retail traders jump on the train that is going up, the price stops rising, rolls back into the previous range, forcing those who are buying near the previous highs to close it as a loss. For those of you who have ever traded crypto, does it sound familiar? When everyone around you is shouting, buy crypto, Bitcoin is going to $1 million, and everyone is buying crypto and they're buying on top when everyone around is already, oh, you should be buying already now. And then the moment people buy, the price stops rising. Have you ever had this before? FOMO. Yeah, you can say it FOMO. You can call it in any other way, but such trend traps often appear around news releases, for example, or around the very hype assets, like, for example, Bitcoin. Every time Gersh said yes. Or it can also appear ahead of key events, like, for example, the Federal Reserve interest rate decision, or like the PCE or CPI numbers being released, or before a very important geopolitical release happens. Okay, so there is a hype going on always from all the corners. You can usually hear the news about certain assets going high or low, like, for example, sell oil or buy Bitcoin, and then all the retail traders buy this idea, the trend stops and reverses. And the fourth type of manipulation in the real market is something completely different. It's called the expanding range or expanding triangle. Okay, so here in this situation, the market alternates breakouts up and down with an increasing range. So the range was small and then it like kind of continues wider. So price draws like an expanding triangle, and where each and every single push to the upside or downside exceeds the previous high or low, and the next basically creates a more like wider and wider range in the market. So usually people, when range starts, they place buy stop, sell stop orders, stop losses above the high, below the lows, and they try trade inside of the range. This expanding range automatically kicks all those stop losses out. The market takes the money from any inconsistent breakout trader on either of the sides. And again, the driver is liquidity hunting. Major big market players essentially benefit from kind of shaking the tree of retail traders, right? To gather all the volume and all the money from both sides of a larger position. And the further the market goes, the more people believe that the next push is a breakout, and the more people try to get on the breakout for the trend continuation, and the more of those get dropped. And across all those four cases, the takeaway is essentially one. The market constantly sets traps for both long and short hour positions, and this isn't your paranoia. Like if you ever felt like your stop loss has been hunted, it's because this is how financial market works. If you want to make money in the financial market, you need to be either faster or smarter or have a very specific set of rules to be able to take the money away from someone and not let your money being taken away to someone else. Okay, so this is essentially how the market works. Big money is going to steer price towards zones where profit awaits them. That is where people's orders and stop losses are placed usually, because clusters orders and our money is the liquidity for them. So liquidity is today's keyword for the webinar. And in this sense, in those four manipulation kind of types, liquidity means exactly those placed together market orders, for example, stop loss orders, limit orders, stop orders, that let big players execute their own big amount of positions with the smallest possible slippage. So, for instance, by sweeping their orders on the euro futures, for example, a market maker taps into the surge of market sales from retail traders and happily sells all those orders that they have at a better prices. So then the market reverses and the big players sit in the profit while the retail traders are got out and pushed out in a loss. So the key idea before we're going to move forward is by understanding those mechanics, we as retail traders can learn how to avoid falling in this kind of traps. And even better, how to spot them and trade with big, large market players using those very traps against the crowd. How exactly? Well, we need specific tools that go beyond what normal average retail traders uses, right? Tools like, for example, volume, order flow analysis, and cumulative delta, which we're going to be discussing today, are going to help us to see what's behind the candle and answer this important question, not how, but why in the first place, and then, of course, how as well. So why does the price move? Why is it reversing? Why is it not going where it's supposed to go? And how can we benefit from it? So before we continue into the actual cumulative delta and the market trading techniques, quick question. How many of you have experienced at least one of those type of manipulations in the market before? Maybe you got hit on your stop loss right before the market reversed, for example. Or your pending order got executed and the market immediately reversed against you. Can you please drop plus if you have ever experienced that? I personally can drop you 1,000 pluses in the chat right now. Because in the past 9 years, trust me, I've had countless of those situations. And obviously, I've had less of those when I started to understand the reason why. But before that, I was trading normal price action or indicators, and I was learning on like baby peeps and stuff online, and like where 99% of the traders learn. And then, of course, if you do the same what 99% of the retail traders do, you're gonna eventually get the same result. Yeah, more times than Trump has tweeted. Usman, wow, that's a big amount of times. I love this comment there. Thank you for sharing it in the chat. Thank you, guys. You are not alone. Okay, you are not alone. There is nothing wrong with you. You are completely fine. You just need some tools to be able to know it in advance and to not get trapped on it and benefit from it. This is what we're going to be doing today. Rax is probably putting the amount of times that I was stopped out in the beginning of my trading career. Yeah, Kyle, thank you. I really, really appreciate that. Thank you so much, Kyle. Good to see you, by the way, here. Okay, so we are going to dive into one of my favorite tools, which is called the cumulative delta. To effectively trade trumps, right? We can call it this way, even because thanks to Trump, we have even more traps in the market now, or manipulations. So you need to master this one indicator. Let's quickly recall what delta is. Okay, first of all, before we're gonna move forward, the delta, okay, this is one of the indicators in ATAS that you can use, and we talked about delta in the first marathon of the series. Delta is going to be directed towards the difference between asks and sells. This is the indicator that you can find on your ATAS platform in the menu of the indicators, and I'm going to share with you later on how to add it to your chart as well. So don't worry if you feel confused, we're gonna do it together. There are two types of deltas, at least a basic one in your ATAS, and then there are multiple ways to reflect cumulative delta and normal delta based on the footprint, order flow, and normal indicators. This one chart represents the price chart on top. So this is a normal price chart, the Japanese candlestick. Below it is an indicator called delta, and below it is an indicator called the cumulative delta. So what is the difference between all three of those? To be able to understand it better, okay, we first need to refresh the order types, and then we're going to get back. In the first webinar, we were talking how the orders get executed and filled in. And first of all, there are two order types. Some of you already know this. Some of you who are joining us today for the first time, this is a new information for you. But we have passive and aggressive order flow in the market. Passive order flow refers to the pending orders, to the orders a kind of buy or sell limit. Passive orders are essentially pending limit orders, and by using pending orders, traders specify their desired entry price and patiently wait for aggressive traders to accept their offered price. The passive order flow is called this way because if I, as a trader, place a buy or sell limit order, I'm a passive trader. I don't do anything besides placing the passive order and waiting for the market to come to my entry price. Now, how do the orders get filled? Passive sellers, those who use sell limit orders, require an aggressive buyer to execute the order. Similarly, passive buyers, so limit buy orders, need aggressive seller for the order to be filled. So the sell limit order is matched with buy by market order in the market, and buy limit order is matched with a sell by market order in the market. And market orders are called aggressive order flow. Those are orders that require immediate execution, and traders use aggressive orders, buy by market to sell by market, when they want to enter the trade immediately, right now, without specifying the price, but getting at the market right immediately at the moment. And they are able to and willing to accept the best available offer. So the buy by market order is filled by the first available sell limit order, while a market sell order, so sell by market order, is executed against the first available buy limit order. How do those two types of orders act in the market? Aggressive orders push the price. So the price is moving when we have more buy by market orders coming in the market than sell by market orders. And those buy by market orders are tapping into sell limit liquidity and pushing the price up. The same way market is going down, so price is falling, when sell by market orders are hitting the market, filling in buy limit orders, okay? And the price is going down when there are less sell limits orders available at each and every single price level than there are buy limit orders. So the conclusion I want you to take from it is aggressive orders push the price. They move the price. Was answering this question, why aggressive buys don't match aggressive sells? Because the market doesn't work this way. Because if you look at the depths of market, and you need to go back to the marathon number 1, the first webinar of marathon number 1, I was showing the depths of market and the market auction, how the orders get filled. So by the bid and ask, it's impossible that aggressive buyer gets filled with aggressive seller, because there is something that is called the spread exists, the best available bid and the best available ask. So those two do not match. And limit orders are the liquidity of the market. Aggressive orders are matched with limit orders for the price to actually change. So The first marathon, the first webinar, or the first marathon, I explained the depth of market and how the market auction works. So aggressive orders push the price. Answering this, if there are no limit orders, market is going to go as high or as low to reach the next limit order. This is what happens in the non-liquid markets. If you trade a non-liquid stock or non-liquid cryptocurrency, for example, you're going to have the price jumping. So the chart is not going to be flowing, but the price is going to jump. It's because there is no limit orders below or above or below. So the price has to jump to reach the next available bid or ask. If there is no more limit orders, the price is not going to move at all eventually. So that's a non-effective, not liquid market. Coming back to the topic, passive order flow is an order flow that stops the price. If there is a wall of sell limit orders and buy markets are pushing the price higher, but there is 1,000, 10,000 sell limit orders, and if there is not enough buy market orders to fill in those sell limit orders, the price is going to stop. The same will happen the other way around. So the passive orders, buy or sell limit orders, actually stop the price from moving. They act as a wall. Aggressive orders move the price, passive orders stop the price from moving. Now, already knowing and refreshing the information about aggressive and passive order flow, let's remind ourselves what delta is. Quickly recalling, delta is the difference between market buy volume and market sell volume. But delta only calculates the aggressive order flow. So only the amount of buy market minus the amount of sell by market. In other words, it can be said as the formula of delta is how much volume in contracts was bought aggressively minus how much volume in contracts was sold aggressively. And the amount that you have is equal to delta. So coming back to this screenshot here, the delta indicator, which is in the middle, shows you the difference between ask and bid for every single candle. Okay, do you follow so far? Can you please put 1 if you are following so far, if that's okay? So for example, if 100 contracts were bought aggressively, buy by market, and 80 contracts were sold aggressively, sell by market, during one candle, delta will be equal 100 minus 80, it's 20. So the positive delta shows that there were more asks than bids, so the buyers were more aggressive than sellers, and negative delta shows you that sellers had an upper hand in the market and they were more aggressive than buyers. Okay, I see some 111s. Thank you so much. Fantastic. So now, as we are familiar with the concept of aggressive orders, passive orders, and delta, what is the cumulative delta, which is the third and the indicator at the bottom? Well, cumulative delta is the running sum of a delta over time. So you take each bar, okay, or a candle, calculate the delta, and keep it adding up from a defined starting point. So for example, starting of a trading session or the beginning of the contract. So let's say on the first delta indicator, or like first bar of the delta, normal delta in the middle, that was 10 contracts, then 5, then another 10. So cumulative delta will be adding up all these numbers. Simple words. Cumulative delta adds the number of every single delta bar. That's why it's called cumulative. Accumulates the numbers. So the key difference is that regular delta is bar specific. So each bar has its own value. And cumulative delta builds a complete picture of buying or selling balance from a fixed starting point. So for example, at session open, cumulative delta is 0. First minute buyers, for example, have the positive delta. Cumulative delta is also going to be 50. Next, seller comes in and delta is minus 30. Cumulative delta will be 50 minus 30. It's going to equal 20. And so on, dynamically throughout that trading day. So one crucial thing to note is cumulative delta is independent of chart time frame, essentially. So whether you're viewing it from 1 minute time frame or for 1 hour chart, it's calculated from the start of the trading session, and its value is going to stay the same. It's going to just show change rapidly or slowly depending on the time frame you use. So it gives you a broader and more consistent view of buyer or seller pressure than a regular delta, which fluctuates with every single and each bar. So cumulative delta can be flat, it can be falling, and it can be rising. How to interpret it? So when cumulative delta is hovering at the same time with no clear trend, so the consolidation at cumulative delta, buyers and sellers are roughly balanced, and the market is in its value or balanced mode, right? Remember the first webinar. If cumulative delta is falling, red or negative, so cumulative delta is falling, it means that aggressive sellers are in control. So the market sell pressure is growing stronger. And over time, we had sell by markets coming in the market, pushing the cumulative delta lower. And negative cumulative delta is typical in a downtrend conditions where obviously sellers dominate. And a rising cumulative delta, green or positive, depending how you reflect it, means aggressive buyers are cumulatively overweighting sellers. And there are progressively more market buys hitting the market. A positive cumulative delta usually also accompanies an upward movement in the market, so uptrend, and confirms the buyer dominance. So to put it very, very simple, cumulative delta tells you which side of aggressive order flow, bullish or bearish, is currently steering the market, and in its excellent confirmation for the price action. Usually, okay, if the cumulative delta is rising, the price should be also rising. Because by the market logic, if there are more aggressive buyers coming in the market, price should be also growing up. If there are more aggressive sellers coming in the market, the price should be going down. Of course, it's not all so simple. And sometimes there are manipulations, which we talked about earlier, which cumulative delta is a perfect indicator to reflect. This indicator is, of course, built into ARAS, and by the way, it's one of the platform's signature tools. You will be able to add it to your chart. I'm going to show it in a second. And this is a tool that is going to be perfect, your helper to identify when the market is set to drop the retail traders. ARAS also offers us the related features, like, for example, cluster statistics, where we can also display the session delta as a number, and footprint charts, which can help us to see the delta at each and every single price level. Today, we are going to be focusing only on the running cumulative delta indicator. So the question is, how does it help us to spot the traps? Well, quite a lot. So because cumulative delta can tell us whether the breakout is false or genuine, and it can highlight the moments when the big player is absorbing the crowd's money and orders, exactly what creates the traps. Now, let's quickly check that everyone is on the same page before we're gonna move on. I have a very important question to you, so please listen carefully. If you see cumulative delta showing deeply negative since the market opening, what does it tell you? Who is in control, buyers or sellers? If cumulative delta is deeply negative, from the start of the trading session? Who is in control, buyers or sellers? Let me know in the chat. Great. Okay. Anyone else? Are we all on the same page? Great. Fantastic. Thank you so much for the answers. Yes. Yes, everyone, fantastic. Great. That's theory sorted then. And let's move on to the third part, how cumulative delta behaves during drops and how to use it to identify false breakouts. That's what we're going to be talking about today. One of the examples that we will be covering, and there are over 8 ways that I personally use and I usually teach 8 ways to identify the market drops using cumulative delta. But for the purpose of today's webinar, we are going to focus on just 2 of them. And the principle of their drops that we're going to be covering is displayed on this specific screenshot before we're going to move to the real chart. So there are imagine, let's say like this, that cumulative delta is rising, but the price, although it should be rising, it keeps flat and it keeps consolidating. Remember that delta only counts aggressive market orders, while timing orders are not reflected in delta at all. That's important. So if cumulative delta keeps rising, but price is consolidating sideways, it may signal that a wall of sell limit orders is absorbing the aggression of buy by market orders without allowing the price to break higher. So imagine that above this current consolidation, there is a wall of sell limit orders. Accumulative delta is rising, showing us that a lot of buy by market orders are coming in the market. But price, although there is a high buyer's activity, is not growing. In other words, price is hitting a wall. So again, this is how it's going to look on the chart. What can we expect next if we see the situation like this? There are 2 potential scenarios that may happen. In the first case, price consolidates long enough to accumulate enough volume and to break through the wall of the sell limit orders. At some point in this scenario, price and cumulative delta both will realign again. And we will often see that both price and cumulative delta getting stuck in a tight range after all. So if cumulative delta would be, for example, consolidating afterwards and the price also, it means that eventually they realigned. And if you see this situation, then it's better usually to not enter the market or to manually exit the trade if you're already in. In the second case, and this one that happens more often, the wall of sell limit orders holds. And price fails to break through and eventually reverses and starts dropping. This is what you can see on the chart. We see that cumulative delta was rising. The big players, big market participants didn't let the price rise, absorbing the buyer's activity using their sell limit orders. And they wanted the price to drop. So when they absorbed all the liquidity from the buy by market orders coming from retail traders, the price started dropping and they started to enter their own sell by market orders. Cumulative delta also begins to decline. And this is exactly the reaction that we are most interested in, and the one that we're going to be turning into the trading method for today. So you can take a screenshot of that as a reminder of what you're going to be looking at the market. And let's move on to our chart. Let's add the cumulative delta to it and walk through a few examples live. There we go. So this is if that would be completely random, I wouldn't be teaching that. So perhaps you're looking at a different situation than the one that I'm describing, or perhaps it's you've been perhaps not looking at, long enough divergence. So let's first talk about the euro futures and a few historical examples that we had. And I have a very funnier, I have a live example for you actually, which is really great for their futures on the pound. First things first, how to add your indicator to the chart. Now you have the chart, right? How do you add the cumulative delta? You go to the indicators window, which you can find on top of your screen. For those of you who are familiar with that, great. For those of you who are not, the indicators windows are here, or you can also open it by pressing the Ctrl+I hotkey. Once the indicator window is opened, you type in cumulative delta. And we want to add the one which is called the CVD, cumulative volume delta. You type twice on it, and you wait until the indicator moves into the edit window. From the settings, you can select essentially the visual mode, candles, bars, or line. For this specific candle trading methods, I'm going to be using candles. Session delta mode default. Okay, so I use the default one. Apologies. You can also set an alerts. We are not going to use it for today's methods. And you can change the visual settings of the cumulative delta. So you can change the color of the candles, the text color, right, and where the zero line is placed. So once you selected everything and changed it appropriately to your own preferences, you click apply. And I suggest that you pull it and extend the cumulative delta at least to 1/3 to a half of your screen. Because to be able to see the divergence, you need to be able to clearly notice the difference between the price, Japanese candlesticks, and the cumulative delta. I, in advance, selected a few of examples so we can save time on our webinar. So the things that we're going to be looking at are the moments when we have the divergence between the price and cumulative delta. And we're going to add 2 files for you in the end of our today's webinar, which you can download. One is going to be the small cheat sheet, which you can download, and it's going to tell you that if the price consolidates and cumulative delta is dropping, you are looking for the buy movement. On the other hand, if cumulative delta is rising and the price is consolidating, you will be looking for the bearish movement. So you will be able to download that cheat sheet and the template for this chart for those of you who just started to use ARAS and just getting familiar with the platform. So if the price is consolidating, and this is very important, you want to look for the specific period of time. So the question that you're asking yourself, during the same period of time, from the point to the point, did the price consolidate and did the delta go higher or lower? If I'm going to select the same exact period of time on the cumulative delta, I will clearly see that the price has been in the range and the delta has been declining. So what is it telling us? It is telling me that we had lots of sell by market orders coming in the market. We see that delta during this period of time declined from minus 2,000 contracts to minus 5,000 contracts. So we had 3,000 higher amount of bids, aggressive bids than asks. But from this to this point, price didn't change the value. So it's been consolidated. We see from this to this point, it was exactly at the same level. The moment the price comes back to the same support, if I see the divergence on delta, I can look for confirmations, for example, on volume, or the confirmations on, for example, their footprint charts and imbalances, stacked imbalances that we discussed in the first webinar, and enter the trade. So I'm going to be looking for the upwards movement when delta was declining and the price was consolidating. I'm looking for this either on the 5-minute or 1-minute or 3-minute time frame. Alternatively, you can use also range XV charts in ARAS platform. So when you go to your time frame selection, you can use the range XV charts for this method as well. They also apply. So range XV, 5 minutes, 3 minute, or 1 minute time frames. If you will be looking for this at the 30-minute time frame and so on, it's going to be too high of their time frame to be able to determine their manipulation and the entry point. So on the high time frames, it's more difficult to select the divergence, and the cumulative delta essentially shows you the moment to enter the trade. Okay, so I'm using essentially the smaller time frames or range XV charts for this specific trading method. Although I'm an intraday to /swing trader, so I analyze my charts using volumes, overall, right? Margin zones and other order flow tools and others, and then I confirm it with one of the methods is a cumulative delta. Let's move on to the next examples. Similar situation, exactly the same. From this point to this point, what has happened to the price? Nothing. It's been ranging. It came back to exactly the same point. So if the price was consolidating, but cumulative delta has changed from minus 1,000 to, at the lowest point, it was minus 2,000, and at this point it was, let's say, minus 2,000 contracts as well. It means that we had more aggressive bids than aggressive asks for more than 1,000 contracts difference, but the price didn't go down, which means here we have a wall of buy limit orders absorbing the sell by market orders. Because remember, right, we talked about it a little bit earlier, that sell limit orders are matched with buy by market orders, and buy limit orders are matched with buy limit orders are matched with sell by market orders. So they are absorbing their activity of aggressive sellers, right? So we see that the price was consolidating, delta was dropping. So what do I look for? I look for the buy market order when the price comes back to the same level as the previous support from which delta started dropping. Okay, so I can confirm it by the footprint, by imbalances, by the volume, whatever I want. Now, the same principle is going to be the opposite. If the price is going to be consolidating, but cumulative delta will be rising, I'm going to be looking for a sell. I want to show you a real life market example. And this is the one that you can afterwards confirm and check. So that's really great that we have actually the live example, because you can see how the cumulative delta has been working in their real time, in the real market conditions. So I really love the fact that we have this, because you will be able to actually see what is happening. So what do we see? We see that the price has been consolidating for a while, and cumulative delta has been dropping even more. Yesterday was the same. The price has been consolidating, right? Here, it came back to the same exact point, but cumulative delta was going down. So the price has been holding the same exact value, more or less, while the value of the amount of sell by market contracts was from positive delta to more than minus 5,000 contracts. So we had more than 5,000 contracts, higher amount of aggressive bids and asks, and the price still didn't drop. What is that? Well, a massive wall of buy limit orders that's holding the price here. The same thing happening here. We see that the price is consolidating and cumulative delta is what? It's dropping. It's dropping massively. We had a positive delta, 83 contracts, and right now we have more than minus 3,000 contracts in a cumulative delta for their 6B futures contract, which means that we had more than 3,000 contracts, a higher amount of aggressive bids and asks. What is it? The aggressive order flow for a sell is getting absorbed by the buy limit orders, which are being held below the cumulative delta. So what am I expecting? I'm expecting a buy from this zone, the same zone that the price is holding today and the same zone that the price has been holding tomorrow. So I'm going to be expecting the buy from this zone and the continuation of the movement to the upside for the 6B futures, for the pound futures. not the financial advice, but the life example, how the price is, how you can actually use it in the real market. Okay, so those are a couple of examples. Let me try to find if we can see the example of, let's actually another example here. So we see that the price has been consolidating, right? Here it's been consolidating and cumulative delta was dropping. So what we expect a buy. So what happened, the price moved up from the same. This was literally yesterday, 2 days ago. So that was the same exact principle, and this was exactly the same situation as the one that we are looking at right now, but this one already worked out, and this is the new market analysis based on the cumulative delta. So exactly the same. Okay. So let's go back and see some questions in the chat that I might have missed. So let's move to the Q&A part. Let me know in the chat if you have any questions. I already see that you have a couple of those. So essentially, the two trading methods that we will be using from now on, that you will have a cheat sheet on, that you will have the template to use with, is their price is consolidating and delta, cumulative delta, is either rising or falling, which means that aggressive liquidity is getting absorbed. Let me go back to the beginning of the questions. And if you have any questions, please let me know in the chat. I'm here to help you and answer as much as I can. CVD gaps are not filled up. It has absolutely no connection to the order flow. It's not a gap. It's just if you select the session delta mode, so you go to the settings, and if you select the default session delta mode, every single time when the new trading day starts after the overnight layover, delta will be resetted back to 0, and it's going to start calculating and accumulating again from the beginning of the new trading day. So the gaps is not an actual gaps. It's just because the delta is reset back to 0, and it has nothing to do with the order flow. It has no connection. That's a good point. You do not need to trade most of the times. A quick disclaimer: cumulative delta is most likely not going to give you a market IDs and the signals for entering trades every single day, because those kind of manipulations happen maybe 2, maximum 3 times per week on one asset. Sometimes it's going to happen 1 time per week on one asset. But if it happens, it's a very strong confirmation for me personally that there is something going on, some trap manipulation. Traders are going to get stop loss hit, and I'm planning to make my money on it. So you need to be very patient if you're patient enough. And the second disclaimer is, the bigger is the difference between the price movement and the cumulative delta, the better will be your trade, the better reaction you will expect from the price. So if delta is dropping a little bit and the price is consolidating, do not enter this kind of trades. Here you can see that delta is dropping massively. You are not getting the question, or maybe it's not dropping really, or maybe there is no divergence. No, there is clearly a divergence. Here, there is also clearly a divergence. The price is consolidating and there is clearly a huge divergence. So if you are doubting, if you are like, maybe it's not a real divergence, like here was a real divergence. If you are doubting, it's a bad trade. Do not take the trade when you are doubting. You need to clearly see the divergence. It's not going to be within the series of this webinar, but in the end, we're going to have the Q&A session, like Q&A webinar, the last one, where we are going to have all the questions answered, and perhaps I can show you how I implement all of this together and combine it in the one trading system. So yeah. Swen, I wouldn't say that. I wouldn't say that. As long as you have, if it feels hard and you feel lost, it means that you don't have the clear rules what you are looking for. So I'd say it's better to specify the rules and better to specify your trading system to the point when you feel actually confident. It's really important to feel confident about the market. If you feel like it's difficult to read, if you feel lost, it's better that you specify it before you start trading live again. Because otherwise, even the feeling of being not 100% confident about your trading system is going to lead you into emotional decisions. So put together your trading system, set up the clear rules, work out 1 to 3 different trading methods. It's more than enough for the beginning. Backtest it, make sure it's profitable, then start trading live and comparing the results to the backtested results. Game Odyssey, I use it by the session, yes. So because every single day I can see the order flow and the traps that are appearing during the day. So if you see there, for example, if you selected by the contract or by your own custom method, it can work. I'm sure there is a way to make it work, but it's going to be more difficult to select traps. So for those trading methods that I'm discussing today, we are using the session, the CVD by the session calculation, which means it resets every single time the new trading session starts. I am bullish on the 6B, yes, on the pound futures right now. Yes, you can confirm it by the different methods. You can confirm it by the example by the footprint charts. You can confirm it by the volume charts, right? So you can also make it very simple and sell it or buy it from the same support to resistance, right? So this is very simple. Normally, I use a combination of the high time frame volume profile analysis, which we discussed in the first marathon. And I'm still going to be showing how to combine it all in the last webinar of this marathon. So make sure to watch the first one and then come back. You will have already the foundation. I'm going to show you how to apply it. You can also use footprint combination, for example, which we also discussed in the first marathon. So there are different methods that you can use for their entry confirmation. But essentially, every time when the delta comes back to the same point that has been rejected, to the same bottom of the range or the top of the range, if the delta is rising, you look for confirmation to enter the trade. Those are the only scenarios, only 2 scenarios when I trade in the range. Other than that, I never trade in accumulation, like I've said on the first webinar of this marathon. You remember that. So this is the only exception, just because the retail traders are getting trapped and I want to benefit from it. It is good for the long-term analysis, but then you need to change it from the session delta calculation to better a contract calculation. So you will go back to the settings. You change the settings from the default to custom, and you select it, right? The custom session start. You select here the date and the time. So it calculates from the beginning of the contract. And then you can use it for the long-term analysis. Because of course, sometimes, like we said before, the ADM model is fractal. The accumulation sometimes can take weeks or months. And using cumulative delta in those big periods of time can help you to identify where, in which direction the big market participants accumulate in their orders and where the price is likelier to break out from this massive big range that's been formed for days, weeks, or months, long term. So yes, but change the calculation from the session delta mode to the custom and put in the beginning of the contract for the futures contract that you trade. Yes, absolutely. Yes, you can use the free one, but it's going to be delayed. You cannot connect to the real-time data though if you're using the free version of ADAS. You can use the 14 days free trial first and then backtest it and then already connect their actual license to the real data. Yeah, it is. It also good for scalping. For sure, it's good for scalping, especially if you look at the cumulative delta, for example, on the range XV charts. So for scalping, you go here and you change from the time frame to the range XV charts. I use 4 for currency futures. I use 6 for gold, the mini S&P 500, and I use 8 for assets like, for example, Nasdaq. And then you use range XV charts in combination with cumulative delta, and that's very good for scalping. The first marathon, yes, exactly. The first marathon, Mohammed, thank you so much. The playlist link to the first marathon about the footprint and volume confirmations is in the post of Ada's YouTube channel. So you go to the YouTube and you will be able to find the playlist with the first marathon. All of the lessons are there. So for the footprint confirmations, it's also in the first marathon. Unfortunately, I'm not going to be able to show it today because we are running out of time, but you will be able to rewatch it there. And all the way in the end, in the last webinar of this marathon, I'm going to be hosting a very special Q&A where you can ask any questions for the whole hour straight. And I'm going to show you how to combine all the knowledge that we gain for the first marathon and the second marathon in the real-time live market analysis. So I think this is going to be an extremely valuable. Usman, I'm not really sure what you mean by institutional market data. The real market data, the one that I'm using is Rhythmic. If you want the deeper insights, it's usually very expensive. And but there is a centralized market, right? So you can see all the types of orders outside of the dark pools and so on, obviously. So I just use Rhythmic for my trading. You can use any other feed, DX feed, Rhythmic, other feeds. I do have the Telegram one, not the YouTube. Guys, thank you so much for today's. Maybe Ali in the future, maybe if we have enough requests and enough feedback, absolutely, maybe in the future. I was planning to do something like this. For now, let's finish the Atas Marathon. I do have the Telegram, but the announcement, they're all like, I'm also going to be hosting the next week 2 other webinars and then another 2 of this marathon. So I'm going to see you next week. If you haven't watched the first marathon, please go to the Atas YouTube and watch the first playlist as well. We were diving deep into the volume profile foundation, order flow foundation, footprint foundation there, which you can combine with accumulated delta with the AMD model that we discussed last webinar as well. So thank you so much for being here today. Thank you for your kind feedback. I really appreciate that as well. Thank you for being here, for your time, for your trust to me. I'll see you next week. If you will have any questions over the weekend, something that you think about, don't hesitate to bring the questions to the next marathon. I'm going to be very, very glad to see you back here next week. Same time, same place. Links are going to be coming to your email. And remember that today we covered our cumulative delta and the types of manipulation in the market. And I hope that after today's webinar and some practice, you will feel much more confident in when you trade to not get stop hunted as well. And your win rate increases. Please let me know during the next webinars how it changed your trading. Thank you so much. I appreciate every single one of you. Іван, дуже-дуже дякую. Мені дуже приємно. Підключайтеся до ком'юніті. Буду рада вас бачити. Thank you so much, Usman. Have a great weekend, everyone. And I'll see you on the next webinar.